Hey guys, my name is Mike Boyd, this is The Money Flare, and today I'm going to be talking about inflation and whether or not the inflation that we've seen will be transitory or longer lasting. This is part 2 of a 2-part deep dive into the topic, so please check out my previous video in case you're a bit rusty in your knowledge of inflation and CPI and what factors may drive an increase or decrease in CPI. And my previous video was a while ago, so I apologize for the long delay, but I had some things going on in my life that kind of had to put aside this channel for a bit. But now I'm back, and so now I'm here to talk about whether or not the inflation we've seen will last longer than most people think. So in this video, I want to cover what the future may hold for inflation. It's obvious that it's here now. We see it in so many aspects of the economy, but the real question is what will happen going forward? Will this spike in inflation fizzle out and be transitory, just a blip in the overall downward secular disinflation that we've had since the 1980s? Or is this the beginning of a new secular inflationary period like we saw in the 1940s or the 1970s? So let's get it out there right away before I get into the whole video. I'm of the opinion that inflation will last longer than most people think, and I think we're at the beginning of a new inflationary period, very much like the 1940s. I don't necessarily think that inflation will be as high as back then, but I do think that we're in for longer lasting, persistent inflation. So I'm definitely not on the side of inflation being transitory. But to be fair, I want to cover what the arguments are for transitory inflation first. As I mentioned in my previous video, for the past 40 years, we've been in a secular disinflationary period in the West, where the dominant deflationary forces of debt, aging demographics, globalization, and technology have outweighed the inflationary forces to cause a long-term decline in inflation and interest rates. We have moments of short-term transitory inflation spikes that fizzle only to continue the downward trend. Each recession along the way has been dealt with by adding on more debt, lowering interest rates, which pushes investors out on the risk curve into riskier and riskier investments. Asset prices like stocks and real estate have soared far beyond the norm. Rates kept going lower, debt kept expanding, inflation kept decreasing. It was a long cycle, and we now seem to be nearing the logical conclusion near the 0% lower bound of interest rates. Many who argue for transitory inflation would say that this long-term secular trend won't reverse, and that most of the deflationary forces driving this trend have only gotten worse. The debt has ballooned, globalization is still persistent, even with some of the recent sentiment of reshoring supply chains and bringing back local manufacturing. The pace of disruptive technology improving our lives is only accelerating, and every day our aging populations get older with very low birth rates, unable to offset that. Many would argue that when you dig into the CPI numbers, you'll notice that many of the price increases are from things like airline tickets and used car prices and many other sectors directly related to the pandemic. Things like lumber and semiconductors are all being affected by the disrupted supply chains, which are all getting sorted out now. So for example, the price of lumber has fallen 65% from the peak most recently. So the argument here is that the pandemic caused a supply shock, which is now getting sorted out as things get a bit more back to normal. But it's not just the supply side either. Many would say that the demand side is also starting to pull back. Consumer spending on durable goods, big items like appliances or cars or real estate. This spending during COVID reached a level we've never seen before because people were locked at home with nothing better to do than to work on their home, buy appliances, upgrade stuff. But that spending is done. You only upgrade your washing machine once every now and then, right? So not every year. And so the argument is that that demand will be sluggish going forward. And we've seen some recent data to support this thesis. Retail sales are slowing. Surveys are finding that car and home buying intentions are way down. And government spending is slowing down as well. And it's undeniable that we wouldn't have such a large and quick economic recovery last year if it wasn't for the massive fiscal stimulus that the US and other countries had to do. It turns out that people who receive free money from the government will spend it or gamble on stocks with it. So these are the arguments for inflation being transitory. The long-term deflationary forces in our economy are too great, and all the pandemic-related supply and demand imbalances are sorting themselves out. And I understand these arguments, and they are very valid, but I do disagree, and I'm taking the other side of that trade, and now I'll tell you why. First, I want to make one comment on CPI and the argument that I described earlier about the specific components of CPI that have increased. Yes, I agree that much of the increases in CPI have been from pandemic-related components, but one major component that hasn't increased yet in the CPI data, but very much could going forward, is the largest component, which is rents. And the data suggests that when you see this type of gap between the cost of rent and home prices, that gap usually fills up. And so that means either rents need to go up or home prices need to come down. And I think we all know which outcome is more likely given our current environment. We've actually already seen rents start to surge in some parts of the US. So I don't necessarily see a high probability of CPI crashing back down to pre-pandemic levels just yet. Rents could keep it high for the next few months. In fact, if you look at the Richmond Prices Paid Index, which is a measure of the prices of manufacturing, it suggests we could see CPI get as high as 10% before we see any meaningful drop. But that's more short term. I want to now give my arguments for why I think inflation could be elevated for a while, longer than most people expect. And to me, the key variable, as always, when talking about inflation is the broad money supply. In my previous video, I showed the relationship between broad money supply and inflation, and how when the money supply increases, inflation usually follows, as long as we're not going through a major technological revolution like in the late 1800s or the 1990s with the internet. During those periods, the deflationary forces of increased productivity via technology outweigh the inflationary force of increased money supply. So the direction of the broad money supply will determine how inflation will look going forward. At least it'll play a major part, in my opinion. And remember that the broad money supply can increase by either governments running large deficits, like in 2020, or by banks lending. And I believe both could be elevated for a while, causing broad money supply growth to stay elevated as well. And first, I'll start with the banks. Not too long ago, the US banking system was the major culprit which brought about the previous recession that we experienced in 2008. They caused that crash, and while no bankers went to jail or were prosecuted, they were rightfully scrutinized from regulators following the crisis. Now, I'm not an expert in banks or banking regulations, but I do know that regulators came down hard on banks and put in place stringent rules limiting the risks that they could take. Basel III regulations were a direct result of this. And some would say that a lot of these regulations were overly strict. So following the 2008 crisis, banks were not in a good position to lend into the economy. That's why even with the large fiscal stimulus and the quantitative easing and money printing that we had back then, there was no growth in broad money supply. The government side of the equation was only offsetting the drop in the bank side of the equation. So overall, the broad money supply didn't grow following 2008. And that's why we didn't see any persistent inflation as much as many people thought we would have back then. But the situation in 2021 is very different. As a result of the strict banking regulations, banks in the US are now in a very good position to start lending again. Their balance sheets are looking better than ever, and they are significantly less levered compared to how they were back in 2008. And while lending hasn't started to pick up just yet, the kindling has been set. Banks are ready. They've loosened lending standards, meaning that it's easier for someone to get a loan. And that combined with a very healthy US consumer with some of the highest savings rates that we've seen in years, over 50 years actually, and inventories at all-time lows that need to start getting rebuilt, we could see banks taking the baton from the government side to keep broad money supply growth elevated. Bank lending always bottoms following a recession and expands as we recover, and I don't see this time being any different. We've already seen credit card lending start to uptick big time, and this could be further fueled by wage growth, which is also very possible, and we're already seeing signs of wage growth and of inventories getting rebuilt, suggesting that we could be at the beginning of a new credit cycle and a continued surge in broad money supply. So overall, banks in 2021 are in a very good position to start lending into the economy and to keep the growth of broad money supply elevated and going into the hands of those who will most likely spend that money. And that's key. Unlike the past 10 years, I don't see this new money growth getting trapped in the financial system and leading to rampant asset price increases. And I'm going to delve a bit more into that a bit later. So anyway, all of this could keep inflation higher. Not too high, but definitely higher than most people would expect. And it's kind of ironic that banks were the culprits in the last crisis, but they may be the ones to bring us out of this one. So we'll see how things go. Now, on the other side of the money supply equation, I think that regardless of the improving banking situation, there's also a high probability that governments around the Western world will keep running large deficits, keep printing money, and do everything possible to bring about inflation. For decades, central banks used monetary policy to control the economy by changing interest rates, so by raising or lowering rates. But now that we have interest rates near 0%, we seem to be shifting to fiscal policy as the main tool for stimulating the economy. So stimulus like what we saw during COVID. And this is the big paradigm shift that the pandemic caused, and I don't see it changing. I've gone over this a lot in my previous videos, but Western society is pretty divided at the moment, and no division is greater than the wealth gap. Over the past 40 years, we've been going down a slow path of more and more wealth concentration and wealth inequality. Outsourcing and automation have led to great productivity growth that went to enrich corporations and the wealthy rather than the blue-collar worker. Before 1980, Increases in productivity led to increases in wages and salaries, and the two went hand in hand. So it was a very egalitarian relationship where workers benefited from an increase in GDP. But since 1980, that relationship has broken, and the average worker is not benefiting from increases in productivity anymore. Wages have gone sideways, and instead all those productivity gains are going to corporations and the 1%, the ultra wealthy. As a result, over the past 3 decades, the share of net worth held by the bottom 90%, so the vast majority of the population, that's been on a steady decline, while the net worth held by the top 10% has been on a steady increase. The discrepancy between the two widened drastically ever since 2008, and the level of wealth inequality that we see now is extreme, and people have had enough. And I think it's a major driver that has fueled things like populism and Trump and the rise of meme stocks and crypto. That's what happens when you have supply-side economics like what we've had since 1980, and you have more money going into capital rather than labor. So giving corporations tons of money at really low interest rates causes this, and it's also deflationary because corporations spend that money to reduce costs, to compete, to increase efficiency and lower prices. Amazon's a clear example of this. They were selling things for a loss on purpose in order to capture more market share. And so for 40 years, we've seen persistent disinflation, and interest rates have marched lower and lower, debt levels got higher, and income inequality widened. But what we've done in response to COVID is more demand-side economics. Governments have directed their stimulus at consumers rather than corporations, which is a completely different story from the 2008 recession when all the banks were bailed out. So in this case, the people are the ones getting the flow of money, and they are much more likely to spend that money, and that's why we may see an increase in elevated inflation. With the American Job Plan and all the infrastructure spending plans, it's clear that President Biden's policies are geared towards increasing wages and perpetuating this transition from capital to labor. And so this is a clear shift that I think will cause persistent long-term inflation. I've said many times that being on the right side of the inflation debate will have huge ramifications on how you should be investing, because these different inflationary periods, whether it be long-term disinflation like the past 40 years, or long-term inflation like the 1940s or 1970s, every environment will have different asset classes outperforming. So it's important to position your portfolio for the proper environment. I've made the case for longer-term inflation and a shift of money going to labor rather than corporations. So what does this mean for the market? Well, I and many other people think that cash flows will matter again, and valuations will matter again, because if easy money goes away, then investors need to focus on companies that make a profit. The environment of disinflation and falling interest rates leading to a massive liquidity bubble that we've had for the past 10 years could be ending. And this is the environment where money poured into tech and growth stocks, causing Facebook, Microsoft, Apple, and Google to represent almost a quarter of the entire S&P 500, almost a quarter of the whole US stock market in these 4 stocks. But as I've already said, that environment could be ending, and we could see markets get a lot less overvalued, especially in the huge tech and growth stock names. We could see a continued rotation to value stocks, away from the super high valuation growth stocks with their cash flows super far out in the future that benefit from disinflation and deflation. And we could see that rotate into the companies with shorter term profits that have pricing power and can benefit from elevated inflation. So that means that I'd stay away from any of the high valuation growth stocks like what you'd find in the ARK ETF, and I'd stay away from bonds. Basically, any bet on the status quo and deflation continuing is what I would generally stay away from. And market history would confirm this. If you look at the past 100 years of market performance, you can see that during times of inflation, especially when we come out of a major recession with high debt levels like what we saw in the 1940s following World War II, bonds get absolutely killed. So from the 1940s to the 1980s, almost 40 years, bonds didn't provide much of a return. It was essentially dead money. That's because as interest rates and bond yields go up, the price of bonds go down. So in an environment of strong growth and elevated inflation, no one wants to lock their money in a fixed interest asset which can potentially yield less than inflation. So bonds do horribly. And that isn't good for your typical 60-40 portfolio of stocks and bonds that the vast majority of people hold. And while stocks do relatively well in inflation and deflation, the clear winners in the post-World War II environment were clearly commodities and gold. And I think that the same could apply again post-COVID. My highest conviction bet is on commodities and value stocks like banks and materials and industrial companies that benefit from surging commodity prices and money fleeing from tech stocks and bonds and finding other areas to go to. So I'm talking copper mining stocks, steel mining, energy, banks, all that kind of stuff. Commodities, value stocks as a whole, and a bit of gold. I don't really think that this environment is as much of a home run for gold like in the 1970s, because I really think that we'll have strong growth in the medium term, which acts as a headwind to gold. Gold does really well when we have high inflation but low growth, and I don't see that happening in the next year or two just yet. But if economic growth starts to slow and we enter more of a stagflationary environment with central banks continuing to print money, then that's when I think gold will shine. And so I'd still hold some gold in this environment. So those are my arguments for why I think inflation will not be transitory and how I think that you should be invested should we be entering this period of elevated inflation, which I think we might be. And definitely I could be wrong, but for now, the data suggests that I probably won't be. And so we'll see how things look. I'll keep monitoring the data to see if anything changes. Anyway, thanks again for watching. Next video, I'll dive deeper into the whole reflation trade and why I think it's not dead yet. So please stay tuned for that. Please be sure to like and subscribe as always. And remember to be careful in these crazy markets. Take care, and I'll see you at the next video.